Investing is about growing your money. It's also about understanding and managing risk. Every investment carries some level of risk. Generally, higher potential returns come with higher risk. Lower risk investments usually offer more modest returns. Finding the right balance between risk and reward is crucial for successful investing. That's where understanding standard deviation comes in. It helps you measure and manage the ups and downs of the market. By understanding this powerful tool, you can make smarter investment choices. You can align your investments with your financial goals and risk tolerance. Simply put, standard deviation measures the amount of variation or dispersion in a set of values. In the context of investing, volatility refers to the price fluctuations of a security or market index over time. A high standard deviation indicates larger price swings, meaning the investment is more volatile and unpredictable. Conversely, a low standard deviation means smaller price fluctuations, indicating lower volatility and more stability. Think of it like a roller coaster ride. A roller coaster with a high standard deviation is like a thrilling ride with steep drops and sharp turns full of excitement and risk. On the other hand, a roller coaster with a low standard deviation is a gentler ride with fewer intense moments, offering a smoother experience. In the investment world, different asset classes have different levels of volatility, which can impact your overall portfolio performance. Generally, stocks tend to be more volatile than bonds, which are considered safer investments. Understanding the standard deviation of your investments can help you anticipate potential price swings and make more informed decisions. Standard deviation is a crucial tool for investors of all levels. Whether you're just starting out or have years of experience, it helps you assess the potential risk and reward associated with different investments, providing a clearer picture of what to expect. By understanding the standard deviation of a particular stock or mutual fund, you can gain insights into its potential for price fluctuations, which is essential for strategic planning. This knowledge empowers you to make informed decisions about whether the investment aligns with your risk tolerance and long-term financial goals. For example, if you're nearing retirement, you might be more risk-averse, preferring stability over high returns. You might opt for investments with lower standard deviations to preserve your capital and ensure a steady income stream. On the other hand, younger investors with a longer time horizon might be more comfortable with higher risk, higher reward investments, as they have more time to recover from potential losses. They might seek out investments with higher standard deviations, aiming for significant growth over time. Remember, standard deviation is not about predicting the future with certainty. It's about understanding the potential for price swings, helping you to navigate the market with greater confidence and insight. Real-life examples of standard deviation in action. Let's say you're considering two stocks, Company A and Company B. Both have shown potential in the market, but their risk profiles are different. Company A has a standard deviation of 10%, while Company B has a standard deviation of 20%. This indicates the variability in their stock prices. This means that Company B's price is expected to fluctuate more than Company A's price over time. Higher standard deviation often signals higher volatility. If you're looking for a more stable investment, Company A might be a better choice. Its lower standard deviation suggests less price movement. However, if you're comfortable with more risk and seeking potentially higher returns, Company B might be more suitable. The higher standard deviation could mean greater rewards. Remember, standard deviation is a tool to guide your decisions. It helps you understand the risk associated with an investment. It should be considered alongside other factors such as your financial goals, risk tolerance, and overall investment strategy. Diversifying your portfolio can also help manage risk. Take control of your investments. Now that you understand the power of standard deviation, take action. Don't let this valuable tool go to waste. Start by researching the standard deviation of your current investments. Many financial websites and platforms provide this information. Assess whether the level of volatility aligns with your risk tolerance. If not, consider making adjustments to your portfolio. Remember, knowledge is power. By understanding standard deviation, you're taking a proactive step towards achieving your financial goals. You're empowering yourself to make informed investment decisions. So, embrace the power of standard deviation and watch your investments soar.